Hello, welcome back to my channel. Today's video we are still on the beginners forex guide, step to step how to trade the forex market. And today we'll be looking at who the broker is. The broker is a company or a platform that connects you, the trader, to the foreign exchange market so you can buy and sell currencies. Think of a broker as a middleman between you and the global currency market. You cannot directly trade currency with bank or large financial institution. So a broker provides you with a trading platform and access. So when we're talking about the broker providing you with a trading platform and access, what are those services that the broker renders to the trader? One, the broker provides you with the trading platform. The broker provides you also with the software where you place trade, such as MetaTrader 4 and MetaTrader 5. The broker also help you to access currency pairs such as Euro USD, GBP USD, USD JPY. The broker also provide for you leverage. Broker also provide for you the platform to open your trading account, make deposit, trade, make profit, and you make your withdrawal to your commercial bank where your money will now, where you can access your money from the commercial bank. So these are the services of the brokers to the trader. So I think this is well understood. You can't just come to the market to start trading. You need to get registered to the broker, open a brokerage account before you can start trading. You also need to be very careful to look out for regularized brokers that before you trust to open your account with. Just like we have the commercial bank, you don't just go to the commercial bank to just open your account. You open your account with a corporation bank that you know that are registered. And so we have brokers that are regulated. So we have brokers like IC Market, HFM, SNES, and so on. And so it's good for you to find out if they are regularized for the sake of the security of your fund. So this takes us to the next topic, leverage. Like I told you, I said the broker provides you with leverage. What is leverage? Leverage means borrowing money from your broker to trade a larger or a bigger money than the amount you actually have. That's number one. Leverage also means it also helps traders to control large trade with small capital. So leverage also means using small money to control big money. So these are different. I'm just trying to explain to you different meaning of leverage. So now I want to go in detail. Just imagine you have $100. You're coming into the market with $100 after you have opened your trading account, and you open your account with a leverage of 1 to 100, and what that means is that your $100 you are coming can control $10,000 in the market. So how do you achieve that? You said, okay, your $100 you are coming with a 1 to 100 leverage, multiply it with 100, then they will give you 10,000. So you have $100 account which is displaying $100, but the capacity of that $100 account can trade a $10,000 account. So now let's take example. So now you want to really take advantage of your leverage, and you're now looking at, you open an account of 1 to 100 leverage. You now take 1% of that 10,000, which is 1%. You're looking at the account as $10,000 account. You now take 1% of the account to open a trade. 1% of $10,000 is $100, and so you place a trade risking $100, and as the trade move your favor 1%, you find out that you've made a profit of 1%, which is $100. You've doubled your account from that $100 you came with to 200. It looks sweet, but the side effect is that if that account trade should go against you, the same way you doubled your account with $100, if it goes against you and you lose it, you have lost your capital that you used in coming to the market. And so when one leverage can work against you, and is also you can work in your favor. And so it is very important to understand what leverage it's all about, deep understanding about leverage before you open your account or before you place a buy or a sell. And so we have different capacity of leverage. We have 1-to-1 1-to-1 10 ratio, which is 100. Let's say we're using the example of $100 multiply with your $10, and that is $1,000 capacity account is low. Then we have 1-to-50 leverage. The same multiplication, it will look like a 500. It will look like a $5,000 account. We have 1 to 100, which we just calculated. We have 1-to-500. We also have some broker that give 1-to-1,000, some insane leverage, 1-to-2,000 brokers. So now understanding leverage and having a risk in proportion with your account will save you. Remember, as a trader, we are all speculating. So there's nothing like 100% strategy, I'm sure, of this market. So if you understand it, you have to take trade based on your account size, not based on the money in your head that you think you want to make. So this is what leverage is all about. Okay, I want us to go to the next topic, which is PIP. PIP. What is PIP? PIP is known as percentage in points, and is the smallest standard price measurement of a currency pair. A pip is usually the fourth decimal place in most currency pairs. Let's say, for example, Euro USD move from 1.1000 to 1.1005. That changes of 0.005 is equal to 5 pip. The same way, let's use GBP USD. GBP USD move from 1.2500 to 1.24090. It means that GBP is selling, and so the difference is 10 pip, 0.0010, which is 10 pip. And so there's a special case for the JPYs. For pairs like USD JPYs, GBP JPYs, AUD JPYs, a pip is the second decimal place. Like, say, for example, 110.25 or 110.30 minus this from this, this is the pip, minus this from this is 5 pip. So now let's look at this picture here. Let's say this Euro USD is as 1.15382. Now, in calculation of the pip, we are told that the pip is the fourth decimal place in most currency pairs. So for this pair, let's say Euro USD, now your pip starts from here. 1, 2, 3, 4. This is known as pipette, which is insignificant. And so when we are saying this 8, it means 8 pip. When it's 3, it's 38 pip. When it comes to price starts shifting to this side, you are talking about in hundreds or 500 pips. When it now shift to this way, you are talking of thousands of pip. I hope you can get it. Now let's say, for example, this price now 1.1538. You are buying Euro USD, and it now move from 1.1538 to 1.1548. The distance between here to 48 is a difference of 10 pip. So when you are calculating pip, you start from this, the fourth number down towards this. As the pip is increasing, getting to 100, 200, you begin to affect this number. When it start getting to thousands of pip, you begin to affect this number. So that's what pip is all about. So I want to quickly show us an example. This is USD CHF, which is US dollar versus Swiss franc. Okay, now let's say, for example, now when we talk about pip, now look at this price. Um, the entry, this is what we call forecast tool. It is used to calculate your entry price, your stop loss, and your take profit. This green part is the take profit, this the stop loss. And so let's say, for example, let's come to this place now. Let's say, for example, I want to buy USD CHF at this price 0.7861, and after buying it, and then price now move in my favor to 0.7885. So from 0.7885 to 0.7865, you can see, let's look at this 0.78, they are constant. Why this last two is really changing faster? It will get to somewhere here before you see 9 being changed. So when the time price gets to 9, price is already moving into hundreds. But from tens of pips, 20s, as it's moving like from 0.7861, 0.7862, this is 1 pip. Now from this 0.78686 to 0.7861, we are looking at 85 minus 61. We have 24 pips. So price has moved in my favor, 24 pips. So this is where you can see this last two. This is what I say, pipette. You don't really put attention on, we ignore. So but price tend to change faster on this edge, on this two number, which is this one is counting like 1, 2, 3, 4, while this one is counting in tens. So price tend to change faster on this last two compared to this. You see this one being altered when price are moving towards 100 pip, just like I showed us in Euro USD. So now let's look at when we talk about GBP. So this is USD JPY. USD JPY. In USD JPY, we said it begins to change from the 2 decimals. So look at, this is 152.90. So your pip you start counting your pip from here, this last two. After the decimal, the next two, you ignore this last one. So it is when it wants to start moving in hundreds that you start seeing this number begin to alter. As it begins to get to 1,000, you will see it will start changing. Let's look at it. It will start changing from 159 to, you can see, 156. So this is how it is. This is how it is. So it's something that you need to really spend time on. So now let's look at it. From 1.156.42 to 156.84. What is the difference? The difference is 1 point is about 38 pips. Yes, about 38 pips. The movement from here to here is about 38 pips. The movement 157.52.157.71. The difference is about 19 pips. So the same way, if it's descending, the same way from this, in trading, we buy low and we sell high. So when it comes to selling, your price here minus the current price will give you the pips. So this is what pips is all about. This, what is lot sizing? Forex is commonly traded in specific amounts called lots. A lot is a unit measuring a transaction amount. When you place order on your trading platform, orders are placed in sizes quoted in lots. We have three types of lot size. We have the standard lot size, and which is standard lot size represent lot 1 to infinity. Lot 1, lot 2, lot 10, lot 100, lot 1000, and so on. These are standard lot size. We just told you now that price move in the market in pips. So when you move 1 pip, so you'll be able to get this very well. And when price move 1 pip for a standard lot size 1, you're making $10. And when you move 10 pips, you're making $100. When price move against you in 1 pip, you are losing $10. And when price move against you 100 pip, you have losing $100. So this is what standard lot size is. So the same way when you are using lot size 10, when price move in your favor on 10 pip, you're making $1,000. When it goes against you in 10 pip, you're losing $1,000. So that takes us to the next lot size, which is the meaning lot size. In the meaning lot size, we have 0.10 to 0.99. So meaning lot size, when you price move in your favor, let's say we are using lot size 0.10 and price move in your favor 1 pip, you're making $1. When you move in your favor 10 pip, you are making $10. When you go against you 10 pip, you are losing $10. And so let's say, for example, that account of $100, and you take a trade 0.10 using 10 pip as your stop loss, and price move in your favor 10 pip, you have made $10. And when it come against you again, when it hits your stop loss, you lose $10. And so what is losing $10? You find out that you still have about $90 to come to trade next day. Unlike you using standard lot size 1 and now use 10 pip as your stop loss, you are risking your whole capital. When price move in your favor, you double your account, you make $100. But when it goes against you, you are losing the whole of your account and your money is gone. You cannot trade again as a trader. So it's very important to know that lot sizing is very important as a trader. If you the when it comes to trading is all about how many times can you come to the market. If you are a trader and you don't have capital to trade, you are not a trader. What makes you a trader is for you to be able to place a buy and sell. So now let's move to the micro lot. Micro lot is 0.01 to 0.09. So 0.01, when price move in your favor 1 pip, you are making 10 cents. When you move in your favor 10 pip, you're also making $1. So when it goes against you 10 pips, you are losing $1. So using and the same way we 0. We said it's 0.01 to 0.09. So with this now, you could see that for that $100 account, the best lot size you should use is micro lot size. You can play around this micro lot size and your account will not be affected like that. And so you will give you opportunity to come to the market several times, because that's what trading is all about. And so I think when we come, so we will deal more extensively on what lot sizing. So this is stop loss, take profits, order. What is a stop loss? A stop loss is a predetermined point of exiting a losing trade. A predetermined point of exiting a losing trade. So managing and preserving your trading capital is your most important job as a trader. If you lose all of your trading capital, there is no way you can make back the lost amounts. You are out of the trading game. So if you want PIP, if you make PIP, you got to be able to keep those PIP and not give them back to the markets. That's what market is all about. If you lose your capital once, probability that you cannot trade again. And what makes you a trader is for you to come back to the trade the next day. And so that is what trading is all about. And knowing that, you have to come to understand this, that in trading there are losses. But what keep a consistent trader in the market is your losses are minimized and your gains are more. So that is what keep you. And using trading with a stop loss also keep you as a trader. So if you lose because you want to make big amount of money, and you risk all of your accounts in one trade. If that trade goes against you, because what we are doing as a trader, we are speculating. We are speculating which price will rise or fall against the other. So trading is all about speculating. If you come to understand that trading is all about speculating, you take the necessary parameters. You will use your stop loss and use appropriate loss size for you to be able to come back to the business the next time. And so this is really, really very important. So with stop loss, you can only lose the calculated amount of money that you are willing to lose on that account. And so we also have take profit order. What take profit order helps you, just like the way when I showed you a chart map out, okay, like this trade, I showed you a chart. What take profit order helps you, it helps you to exit a trade that is already in profit. Let's say you took the trade and you were not there, you just put in the order. Look at this trade. This is TP1, the order is there. So if price move in my favor, when it gets to this price, it will naturally take me out of the market. So it's a take profit order. And this is the stop loss. When I was talking like stop loss. So this is the focus to, this is the entry price. And I analyze this trade and put my stop loss to be able. Price came back. Price came to the entry, just violated. Okay, I analyzed it when price was somewhere. Price came, it violated, took, activated my order, came back, took my stop loss, and came back and started moving in my favor. So this trade, it really took me out on stop loss. So with the stop loss, I can only lose the amount that I'm calculated to lose. I'm willing to lose based on the risk parameters I've set for myself. And so with the take profit, if it goes in my favor, make the price will take me out on the price that I feel I'm okay for this market to get to. When it gets there, I'm okay with the profits and it will activate my order. And so you could see with this trade, I risk about 11.8 pip, and my risk to reward on this trade is about 11.44. And you could see price really played a long way before reversing. And so this is what um, stop loss and take profit order is. So as a trader, I plead with you, it is very, very important. You look at these three topics that I really taught towards this last part of this class: the understanding the broker, your leverage, your understanding leverage, understanding pips, and also your risk. It is very, very important to a trader. A good trader who is still in the market is still in the market because they understand your risk. You hear that trading is 10% analysis, 30% um, 30% risk, and 60% psychology. So if you have this your risk parameters put in place and you understand your trading strategy and be able to manage your trading behavior, you find out that consistently as a trader you will be in the business. Remember, trading you are bound to have losses. So the losses does not break you as long as it's a calculated loss. It only break you when you did not calculate and you just go in with the whole of your account. So and you end up blowing your account once. So when you take the right proportion of risk, then you will see that you'll be able to be in the market for a long time. So this is where we'll be stopping today's class. So I want you to please go over this video, take your notes, write down. If you don't really understand any points, come to the comment section, ask question, and I will be willing to answer you. So I would like you to please like, share, comment, subscribe, and put on the post notification bell so that you will be notified whenever a video comes into this channel. God bless you. See you in the next video.